Stock Talk listeners, welcome. We're jumping straight into McDonald's Q1 2025 financials today.
That's right.
And the big headline, well, it's a dip in global comparable sales.
Yeah, that's what catches the eye first.
So our mission really is to look beyond just that number. We're using their official report from May 1st to figure out the key trends.
Understand what it means. Yeah, for investors, sure. But also just for anyone watching, how the economy's hitting big consumer names.
Exactly. That initial figure was a 1.0% decrease year over year in global comps.
Right, but, and this is pretty crucial context in the report, you have to remember the calendar. Q1 last year had Leap Day.
Ah, that extra day.
Exactly.
Yeah.
So if you adjust for that, take that day out of the comparison, comparable sales were, well, basically flat.
Okay, so not quite the negative drop the headline might suggest at first glance. It adds a layer of complexity right away.
It really does.
And that kind of nuance, I suppose, carries over into the other main numbers.
It seems to. Revenue was $5.96 billion, which is down 3%. Operating income also down 3% to $2.65 billion.
Yeah.
Net income, same story, down 3% to $1.87 billion.
And earnings per share.
Diluted EPS that dipped 2% down to $2.60.
Now, for a global giant like McDonald's, currency swings always play a part. The constant currency figures, they usually tell a slightly different story, don't they?
They absolutely do.
Yeah.
And here, yeah, they soften those declines. In constant currency, revenue is only down 2%.
Right.
Operating income just down 1%, and diluted EPS also down just 1%. So it definitely highlights the impact exchange rates had in the quarter, gives you a clearer sense of the underlying business momentum.
Okay, so underlying performance maybe a bit more stable, currency having a noticeable effect. Let's break it down by segment then. The U.S. market. It seems like that's where they face some real challenges.
That's definitely what the report suggests.
Yeah.
U.S. comparable sales dropped pretty significantly, actually, by 3.6%.
Wow, okay.
And the main reason they cited, negative guest counts, just fewer people visiting.
So fewer transactions.
Exactly. And they linked it directly to, value-conscious consumers maybe moderating their spending on eating out. It's a trend we're hearing about across the board, really.
That makes a lot of sense in this environment. They also mentioned, and the wording felt a bit cautious, mixed results from promotions and new menu items.
Yeah, mixed results is interesting phrasing, isn't it?
It is.
It suggests maybe that some things are working, some aren't quite hitting the mark as they'd hoped. They might still be searching for that perfect value message or the right new product to really drive traffic again in the U.S.
So still trying to find the right lever to pull there. What about internationally? The international operated markets segment? More of a mixed bag there, too.
It was. Overall, comparable sales in that segment were down 1.0%. But the key thing there was weakness in the UK market specifically.
Oh, okay.
That weakness kind of offset positive performance they saw elsewhere in that group of markets. It just, underscores how different the economic picture can be from country to country,
Yeah.
even within their established international zones.
And currency impacted those numbers, too, I assume.
Yep, strip out the currency fluctuations, and the performance looked a bit stronger on a constant currency basis.
But then flipping to the international developmental licensed markets, that seemed like a genuine bright spot.
Absolutely. That was the positive story in the segment breakdown. Comparable sales there were up a healthy 3.5%.
I mean, where was that coming from?
Primarily strength in the Middle East and also in Japan. The report credits, better local economic conditions in those areas, plus effective menu strategies, things tailored to local tastes.
That localization paying off.
It seems so. It's a good reminder of how they adapt the model market by market.
Okay, let's look at where the actual dollars are coming from. Franchise restaurants are still the bulk, right? But there was a really eye-catching jump in other revenues.
Yeah, that was striking. Franchise restaurant revenue was down 2%, which kind of tracks with the comp sales, came in at $3.66 billion.
Okay.
Company-owned stores saw a bigger drop, down 9% to $2.13 billion. That reflects both the sales pressure and also their ongoing refranchising efforts, selling off company stores.
Right, that makes sense.
But yeah, that other revenues line, it surged 78%.
78%? Wow. To what?
$162 million. And the report says it's mainly driven by increased strategic partnerships and brand licensing deals.
Interesting. So leveraging the brand in different ways beyond just selling burgers and fries?
Potentially, yeah. It's a small part of the overall revenue pie still, but that kind of growth rate definitely makes you notice. Could be an area they're looking to expand.
Definitely one to watch. Now, something that consistently seems strong for them, even when overall sales are pressured, is their loyalty program and digital side.
That's absolutely a key positive takeaway here. Despite those headwinds we talked about, the loyalty program is really humming along.
What kind of numbers are we talking about?
Get this, over $31 billion in system-wide sales to loyalty members in the last 12 months.
31 billion.
Yep. And just in Q1 2025 alone, it was about $8 billion in sales through the loyalty program. And it's huge scale operating in 60 markets globally now.
That's massive. So it's clearly driving engagement.
For sure. The report really emphasizes that. It drives repeat visits, builds connection, and crucially, it gives them a ton of valuable customer data.
Data they can use for what? Menu, pricing?
Exactly.
Yeah.
Optimizing the menu, refining prices, targeting promotions much more effectively. Plus, the growth in their McDonald's rewards platform and just digital ordering in general, it's helping offset some of that pressure on in-store traffic.
Okay, so digital and loyalty remain a core strength. Let's pivot to margins, though. Operating margins sounded like they were under continued pressure.
They were, yeah. Several factors hitting them there. Labor costs are up. Wage inflation is a big issue everywhere.
Sure.
Food and paper costs are also elevated. And while they can raise prices, there's a limit, right? Especially when consumers are so focused on value, you don't want to push them away.
It's a tricky balancing act.
Definitely. And we also saw some pressure specifically on the franchise restaurant margins, likely linked back to those lower sales volumes we discussed.
The report also called out a restructuring charge, didn't it? Something about accelerating the organization.
That's right, a $66 million pre-tax charge related to that initiative. It's basically about their ongoing efforts to streamline things, modernize how they operate.
So investing in efficiency.
Pretty much.
Yeah.
It could involve, changes to internal structures, tech investments, maybe workforce adjustments. It's a cost now, but the goal is to make the company more agile, more efficient for the long term.
Makes sense. And did the margin pressure hit all parts of the business equally?
Not quite. It seems the company-owned restaurants felt it a bit more acutely, probably because they bear those labor and operating costs more directly.
Right.
So, unsurprisingly, management is really stressing cost control, looking at supply chain savings, workforce efficiency, using technology to help out.
Okay, looking ahead then, no specific financial guidance was given, but they did talk about strategic priorities. What are they focusing on?
Yeah, they laid out a few key areas. Number one is value leadership, really emphasizing affordability, critical right now.
Absolutely.
Second, digital enhancement, continuing to build out the app, online ordering, all that. Third, menu innovation, keeping things fresh with new items, limited time offers.
Keep people interested.
Exactly. And fourth, market expansion, especially internationally, where they still see growth potential.
And the CEO, Chris Kempczynski, his comments focused on resilience.
Yeah, emphasizing the company's ability to adapt, navigate challenges. The message was really about doubling down on their core strengths, the brand, the global scale, and focusing on fundamentals.
Sure.
Strengthening the core menu people love, making the digital experience even better, expanding delivery and drive-through, which are huge, and investing in modernizing the actual restaurants. It's about weathering the current storm and setting up for the future.
So if we step back and try to synthesize all this, what are the big opportunities and the major risks that jump out from this Q1 report?
Well, on the opportunity side, definitely that loyalty program and the whole digital ecosystem. There's clearly more potential there. International expansion, especially building on that developmental license to market success, is another one. Menu innovation always offers a chance to excite customers, and driving efficiency through tech is key.
And the risks?
The risks are pretty clear too. Consumer spending staying tight is a big one. Inflation continuing to bite into their costs. Competition is always fierce in fast food. And then you have, longer term shifts maybe toward healthier eating, plus the constant uncertainty of foreign currency moves.
Okay, so putting it all together, what are the main takeaways from this deep dive into McDonald's Q1?
I think the main thing is that it was a really complex quarter. That headline sales decline needs the leap day context, right?
Right. Crucial context.
The loyalty program and digital are undeniable strengths, real engines for them. The U.S. market is definitely facing headwinds from cautious consumers.
But offset somewhat by international bright spots.
Exactly. That performance in the international developmental licensed markets shows they can still find strong growth and adapt globally. So ultimately, their focus on value, digital, and just running the business efficiently seems like the right strategy to navigate what's clearly a challenging environment right now.
Really insightful. It makes you wonder, though, considering that mixed performance globally and how strong loyalty is, what's the biggest single thing McDonald's could do maybe to reignite growth in a core market like the US? Or, thinking even bigger picture, how might those shifts in consumer habits, maybe towards health or different dining formats, really reshape their whole strategy down the road? Lots to think about. Thanks for joining us for this deep dive into McDonald's.